Hello and welcome to our webinar for the afternoon, Weathering the Storm, Building Business Resilience to Climate Change. My name is Joe Casola. I'm the Director of Science and Impacts here at C2ES, and we're very pleased to have with us Jay Bruns, the Vice President of Public Policy from the Hartford. In today's webinar, I'll give a few minutes overview from our report, Weathering the Storm, which we released in July. And I just lost my screen. And then I'll introduce Jay. Jay will speak for about a half an hour, and then we'll have some time for Q&A at the end of the presentation. And you may notice in your little GoToWebinar box an area for questions. We ask that you type those questions in. You can type them in any time during the presentation. We'll collate them, and we'll try to get to as many as we can in the Q&A time that we have allotted. So a quick overview of our report, Weathering the Storm. Weathering the Storm, we did an examination of what companies, how they perceive the risk of weather and climate impacts, and also what they're doing to increase their resilience. During 2012, there were a number of weather-related disasters that led to over $130 billion in losses, with the most costly events being Hurricane Sandy, which just recently had its one-year anniversary, and the Midwest drought. In addition to those events, forest fires and flooding also pose some very high-dollar impacts. Within the report, Weathering the Storm, we looked at some of the business drivers for action, what's kind of motivating businesses to take action, how businesses assess risk and manage this risk, and I think we're really glad to have Jay from the Hartford here today, because there's really no better industry that assesses risk than that in insurance. We also investigated some of the barriers to action and some of the steps that companies are taking. The inputs that we used to our analysis were basically looking at disclosures anywhere we could find them, whether they were in the Carbon Disclosure Project answers, SEC 10K forms, or sustainability reports. And we really focused in on some of the largest companies, the S&P Global 100. In addition to that kind of broad-based research, we had case studies of several companies, including the Hartford, and we also tried to put together some lessons learned from a business workshop that we held. And we've got the website for the report, and we'd also like to thank Bank of America for their sponsorship of this research. One of the interesting kind of takeaways from the report is that risk management can take a lot of forms. A bulk of the companies feel that their business continuity plans kind of take care of some of the extreme weather or climate change related risks. However, only a smaller portion of the companies that we investigated have specific analyses of climate change, or water risk. Also of note, I think a chunk, about 21, I should say not about exactly, 21 out of the 100 companies of the S&P Global 100 do employ insurance in some form to transfer risk. Another takeaway was this four-step process, and I think that some of Jay's comments will show exactly how companies go through this process. The first step is to build awareness, and oftentimes that awareness is internally among staff, but it can be externally among customers as well. The second, to actually assess vulnerabilities, to try to prioritize and understand what climate stressors or weather stressors affect business, and to what extent that those impacts, the kind of magnitude and likelihood. Third is to actually identify options to reduce these risks, or perhaps pursue opportunities where products or markets may be able to grow in a new climate. And last is kind of a continual reassessment and review period. So these are just, this is a generic, I think, playbook that we have in the report to summarize what companies have been doing. Okay, so before I turn things over to Jay, I just wanted to give him a brief introduction. Jay Bruns joined the Hartford in 2004 as Vice President of Public Policy and Government Affairs. Since 2008, he has provided strategic direction to the company's Environment Committee, which promotes the company's environmental stewardship goals through measures such as setting a greenhouse gas reduction goal, reducing paper usage, offering insurance products that support low-carbon technologies, and engaging employees. In 2011, Newsweek magazine designated the Hartford the 12th greenest company in America. Prior to joining the Hartford, Jay served 25 years as a career American diplomat, rising to the senior foreign service, and included postings in Europe and North America. He also served in the White House as Director for International Economic Affairs in the National Security Council. Bruns holds a bachelor's degree from Colorado College and a master's degree from George Washington University, and also attended the Naval War College and the University of Copenhagen in Denmark. Jay currently serves on the board for the World Affairs Council of America and serves as the Vice President of the World Affairs Council of Connecticut. So we're really pleased to have him here today, and with that, Jay, please take it away.
Well, thank you very, very much, Joe, and it's a delight, a pleasure on behalf of the Hartford to speak on this seminar today. And I just want to make sure, Joe, you and the audience can hear me, I assume.
Yeah, you're coming through loud and clear. Thanks.
Great. Well, as you could see from that introduction, even though I have now been at the Hartford for over 9 years, I didn't start out my career as an insurance professional, so I hope that you will forgive me as we go forward. I also want to say that for anyone who attended the rollout this summer in Washington, D.C. of C2ES's report, some of these slides that I'm going to be using today will look familiar, but I do have a little bit more time today to go into some detail, which I hope you'll find interesting. My goal here today is to help increase understanding of how the insurance industry generally, and the Hartford in particular, as a property casualty insurer, looks at the risk of severe weather events and climate change, how we try to manage that risk, and how we work with our customers and our regulators on that risk. So with that, I'll ask that we go to the next slide, please. First, a little bit about the Hartford. It is currently, I think, number 112 on the Fortune 500 list of companies. It is a property casualty insurer. We also offer group benefits and mutual funds. I think it's important in this context to note that it does have now a 203-year history. It was founded here in Hartford, Connecticut, where I am sitting now, in 1810, and has been in business continually since. That means that over that course of time, and by the way, we are essentially a U.S.-centric company. Although we do have some operations outside the U.S., we are really a U.S.-centric company. Over the span of that history of the company, it has dealt with, and we have paid out claims in a long list of weather-related and other catastrophic events, including the Great Chicago Fire of 1872, I think it was, the San Francisco earthquake, most recently Sandy, of course, as well as 9/11. We look back on our history and have insured people like President Abraham Lincoln and his farm in Illinois, as well as Babe Ruth when he was an active baseball player. Currently, we have about 18 million individual customers and 1 million business customers. Our business customers are mostly small to medium-sized businesses. So the Hartford is not the kind of insurer that would insure a very large national insurer, although we do have national accounts. Most of our business is smaller to medium-sized commercial customers as well as individual customers. Currently, we have about 20,000 employees. Our revenue for 2012 was a little over $26 billion. We like to think that in line with our vision that we are a company that is known for, celebrated for our character, and one way that we measure that for ourselves is by our environmental stewardship efforts. And we have maintained a pretty strong level in the Carbon Disclosure Project. We've been on the Dow Jones Sustainability Index since 2012, and as Joe mentioned, we've gotten some recognition from Newsweek. I just thought I would explain very briefly one way that we kind of look at how we can be good stewards of the environment. As Joe said, we look for ways to reduce our own greenhouse gas emissions, to reduce our paper usage, to offer insurance products that help our customers go green, and also to make investments that are green. And one good example, concrete one, is on electric vehicles, for example. We started several years ago to invest in electric vehicle charging stations in a company that offers those, and through that we had the opportunity to install electric vehicle charging stations on our Connecticut campuses. We went ahead and did that in 2011, so we've got the ability for 12 cars in all to be charged at any one time across our 3 campuses. And that, since each up to 24, because you can charge 2 a day. When we did that, we thought we would go one step further, and we started to offer electric vehicle premium discounts for owners of electric vehicles. I think we were one of the first, if not the first, insurance company in the United States to offer that for electric vehicles. And then more recently, we have joined with the U.S. Department of Energy in their workplace charging station challenge. So it's kind of one of these things where you get an idea and you build on it. May I have the next slide, please? I think it's important to do a level set here about what insurance is. And if you go to the normal textbooks on insurance, you'll find out that it's actually 3 different things. It is a transfer system, so where the person who buys the insurance, the policyholder, transfers the chance of financial loss to another policy, and that to another party, and that is, of course, the insurance company. It is also a business, so the Hartford and the other private insurers in the United States look to operate in a way so that we generate sufficient income to pay all the claims that we are exposed to, and at the same time to provide a reasonable profit. And finally, insurance is a contract. It is a legal contract between us, the company, and our policyholders. I think you can go ahead and move to the next slide, please. I'm going to spend a little bit of time on this slide. This pie chart kind of represents in one picture, I think, how insurers generally, in the Hartford in particular, looks at the risk of severe weather events and the changing climate that we're facing. This is a list. This represents all the U.S. catastrophic losses in the United States between 1992 and 2011. So it's 20 years of combined insured losses that are catastrophe losses. A catastrophe loss is defined as any one loss that results in more than $25 million. So, you know, if you have a house and one tree falls on your house and because it was rotten and nobody else has any other losses, that wouldn't be a catastrophe loss. But if a huge windstorm comes through your neighborhood and wrecks your house and many others, then it added up, it's more than $25 million, and that's considered a catastrophe in insurance parlance. So if you look at this, you can quickly get the picture that what private property casualty insurers in the United States are most concerned about are, number one, hurricanes and tropical storms. They comprise about 42% of all insured losses over those 20 years, and that doesn't count Sandy, by the way, which was in 2011. and tornadoes, which add another 34% roughly. So those two kinds of events are the ones that insurance companies are really most interested in trying to protect themselves over, because looking backward, those are the ones that have created the most severe insured losses. Going forward, you can see that winter storms comprise another 7% or so. That's not as large. And then we have in here all of the catastrophe losses, so they include non-weather related ones. Terrorism is the next in line, and that is virtually all 9/11. That's obviously before the Boston Marathon, but even so, I believe the Boston Marathon would have, in terms of insured losses to date, would be really quite small. Then there are geological events, again, outside what we're talking about today, because that would be volcanoes or earthquakes. Next, I think it's kind of interesting. You see, this is, we call it wind, hail, flood. Hail is a very large and growing problem. You'll notice that you would think if flood is included, one would think of all the flood damage over the last number of years, that it would be larger. But if you look in the small print, you'll notice under number 3 that this does not include the flood losses to the National Flood Insurance Program. In 1968, the federal government decided to launch the National Flood Insurance Program. And because property and casualty insurers basically were exiting that market, they were finding that over time there would be too many insureds who had repetitive flood losses, and there was no really good way to price for it and to keep paying the continual losses. So in effect, at least for homeowners in the United States, the private insurers are pretty much not participating in that market. So when we talk about floods, they, of course, private insurance companies care about floods. First, we cover your automobile. So if automobiles are caught up in a flood, that's probably a covered loss, depending on what your policy reads. For commercial insureds, sometimes insurance companies, and we do this in some limited cases, offer flood insurance for commercial insureds. But basically for property owners, they have the opportunity to buy flood insurance from the federal government National Flood Insurance Program. Next, you see fires, and there are a lot of fires, and they do damage, and they're very destructive in many ways. But in relation to the rest of the kind of perils that are weather-related that private insurance companies care about, they don't play a very large role. Now let me just talk a little bit about the picture in 2012, because that slide did not cover 2012. Well, according to Munich Re, during calendar year 2012 in the United States, we had a total of 4 tropical cyclones. They ended up costing, in terms of insured losses, around $26 million. We had 115 severe thunderstorms, which ended up costing about $15 million. Excuse me, those are billions, 26 billion, 15 billion. Drought, 2 bigger events, they ended up costing about $16 billion, but almost all of that would have been covered again by the federal program that offers drought insurance. Private insurers do participate in that, but the federal government is a larger player. Wildfires, the 38 wildfires last year with a total of almost $600 million in losses. Winter storms, there were 2 major ones with $38 million in losses. There were 19 flood events, but of those 19 flood events in 2012, the losses from flood for private insurers was pretty negligible. I want to talk a little bit more about hurricanes and how they, if you look backward, how the kind of risks that they pose. If you think about the insured losses from the top 10 historical hurricanes based on, if you think about the 10 most costly hurricanes in the United States, number 1 would have been Katrina. That cost about $47 billion in today's dollars. Number 2 would have been Hurricane Andrew in 1992 in Florida. That would have been about half that size, $23 billion or so. Then third on the list is Sandy with $18 billion, $19 billion almost in insured losses. Now let's stop and think about Sandy for a little bit. If you think about what the losses are to private insurers, very little of it is flood. There are obviously all those flooded out cars you saw in the photos. Those would be covered, and those would be something that private insurance companies would cover. A lot of the losses from Sandy had to do with the wind. Even though it was not a hurricane when it struck the coast, it was still packing quite a punch and did a lot of damage, wind damage, and in particular it knocked over a lot of trees and things like that. And if a wind from a storm knocks over power lines and then you lose power because of that, and the power stays out long enough so that you lose some of the things that are covered in your insurance policy, then obviously that's a covered loss, and that would be in this $18 billion. Next, Hurricane Ike in 2008, and followed by Wilma in 2005, Charlie in 2004, Hurricane Ivan in 2004, Hugo in 1989, Rita in 2005, and Francis in 2004. So really, if you look at the largest number of losses, the great number of them were in the last decade or so, with a few outliers, including Andrew and Hugo. Then what insurance companies also think hard about is how the demographic changes have taken place over the last number of years. Some hurricanes that hit the United States decades ago, they still remain in people's memory. But if you put in harm's way, if those hurricanes were to hit today, with the way that the buildup and concentration of wealth has taken place along the coast, the losses would be vastly different. For example, there was a hurricane in 1926 that went through Miami, and it was a Category 4 hurricane. According to modeling, if that same hurricane were to go through today, it would cause $125 billion worth of loss. That's that's about 2.5 times what Katrina was. Again, if Hurricane Andrew were to hit the same place again today, given the buildup there, it was a Category 5 hurricane. We would the same area we anticipate would suffer a loss of insured loss of about $57 billion. So one of the main points here is that if you look back in history and just take hurricanes that we know have struck the United States with the certain force that they have struck the United States, if you overlay today the same kind of the infrastructure that is there today and put the same hurricane in place, then the losses would be larger than any insured losses that we've seen to date. Just as an example, if you think about the growth of this of the wealth along the coast, if you just do the estimated value of insured coastal properties that are vulnerable to states, New York is number 1, followed by Florida, Texas, Massachusetts, New Jersey, Connecticut, and Louisiana. So obviously these are kinds of issues that that insurance companies are very aware of and cognizant of and model all the time. Let's go ahead and go to the next slide, please. As with all major insurers, the Hartford has quite a sophisticated enterprise risk management function. It goes deep in this company, as it does in all. companies, and there are a lot of the employees here who spend a lot of time trying to figure out and to assess our risk and to try to mitigate it. So obviously one of the things that we do is we review the risk measures that we have in place. We figure out how much risk concentration we're taking on, and this is not just for weather related, obviously, but for everything else, terrorism risk, for example, or risk if you have a big workers' compensation book of business, you look at the risks involved there. So all kinds of risk concentrations that any average large insurance company would take on. And there is a very built-out way to keep tabs on this risk, to monitor it. I mean, some people are obviously monitoring the amount of risk that the company is taking on as it sells more insurance policies on an almost daily basis, and it is reviewed very often. It's reviewed including at the very top by the board of directors. It's kind of the essence of what an insurance company does, I guess you could say, to try to understand always how much risk you are taking on, and to make sure that you're charging the right price for it, and that you're comfortable with all kinds of scenarios that you play out all the time to see to make sure that your risk concentrations are within what you explicitly would like to have said that is the limit of your tolerance. So how do we, in a kind of day-to-day way, manage these risks? Well, one of the things that we and all other insurers do is use reinsurance, and reinsurance is basically insurance for insurance companies. So if we are, and it's kind of a conscious way of managing our risk. We already decide beforehand how much risk we plan to lay off to insurers. And we spend a lot of time with reinsurers and talking with them to understand how they're pricing the reinsurance that they're charging us for, and making sure that how they view this risk and how they price it is in line with what we're doing. We want to make sure that we're aligned with our reinsurers. Then as we expand, say we choose to move forward in a certain state with a certain line of business, we want to make sure that we expand carefully so that we don't take on unwittingly too much risk, and that we know what the downsides are of expanding that book of business. We obviously talk a lot with our regulators and customers, and I'll talk a little bit more about that later. And then, of course, we do a lot of catastrophe modeling. We work with all of the major cat modelers, and we make sure that their understanding of the risk and ours is the same. And what we find, however, is that because of the state of the science so far, it's really hard. We know that the models, especially starting in 2006, a lot of these have incorporated medium-term forecasts of increased hurricane frequency and severity, and that kind of tracks with our own understanding of the changes that we're seeing. But we're trying to we take the modeling that the modelers do, and then try to improve it by using our own loss experience and our own history and our own knowledge of our own book of business to try to get a more granular, detailed view. The problem is, of course, and we look at we read look at the latest science that's available, peer-reviewed science, and work with scientists as well, with organizations, to try to get a better and better handle on this. For example, we work with a group called the Weather Research Center on severe convective storms. We're trying to get better data on what causes them, what's how if we can see when they might happen, and understand the climate signals that are the role of climate signals on the severity, frequency, and location of severe convective storms. And but it's, as I think everybody on the call will recognize, it's very, very difficult to kind of nail those things down to the point of granularity where we can go to our regulators and say, well, we know that these storms are coming, and so therefore we want to be able to charge more for them out in the future. That generally doesn't work very well. And so far we are spending a lot of time trying to understand and trying to get more granularity out of understanding exactly what is going to happen with storms as the climate changes. Let's see if you could go to the next slide. And so it should be communicating to customers. And there we just kind of an overview of how the Hartford is organized. We sell both, as I said, commercial and personal lines, and we sell both. We sell commercial through agents and personal lines through agents, and some directly. We have an association with AARP, so we do sell some personal lines directly, but most of the time we are selling our product to our customers through an independent agent who offers Hartford insurance as well as the insurance of maybe 4 or 5 other companies. So we generally don't maintain a direct ongoing relationship with the customers. We communicate oftentimes through our agents, and certainly, of course, we do have ways to communicate directly to our customers through phone, mail, online, and social media. And our customers can always come to our website and see what we're saying about how they can protect their assets and themselves, especially during storms. When a storm is coming or after it is hit, we maintain ways to make sure that we react as quickly as we can. We do have a 24-hour catastrophe information center. If, for example, a storm is coming and everybody can see it on the television, we get our claim teams moving into the area just outside the boundary of where we think that the storm will hit. Or in the case of, say, a tornado that's just hit last night, we get our claim teams out as fast as possible. We do have dedicated handlers who know how to deal with large losses. Those are much more complex. We have this operations based in Chicago. And now the mobile technology has gotten to the point where, for example, when our people get to the site and talk to our customers and see that there's going to be a major claim, they can start to make payments right on the spot. So we really take pride in and work hard on trying to react with our customers in the wake of an event as quickly as possible. One example that I worked on a lot this spring and summer was the series of tornadoes that went through Oklahoma. In the case like that, there are just a myriad of complex moving parts. I mean, one thing is one of the first things we do is get a group of people from government affairs, from communications, from claim, from enterprise risk management, and other parts of the company to try to understand who got hurt and what the kinds of losses would be. And already we can map. We figure out, okay, where the risks are that we have. In other words, where our policyholders are and what size of the policies and what type of policies they are, and we can overlay on that map a map, for example, of our best understanding of the track of the tornado, and knowing how strong it was, and maybe the strength changed across that track, and we can begin to make preliminary estimates of what kinds of losses that we face. It's obviously we're there to take the calls that the customers have. We also try to get in on the ground, and one faces as an insurance company a whole list of issues as you go into to an area that's just faced devastation, including our own access. Our access might be constrained because of civil authority, that the police don't want anybody to come in. They don't even let the people who live there go in sometimes if there's that much devastation. So it's hard to go in and figure out how much we will be paying our policyholders when we can't even access the area. So those are the kinds of things that we have a lot of experience now working through that would be key to work through in any major event. I want to talk a little bit about some of the things, ways that we learn from our experiences and how we try to convey those learnings to our customers. One of the things we did in the wake of Storm Sandy was to poll about 450 small businesses who were in the areas of Sandy in New York, New Jersey, and Connecticut right after. And we did that survey, we published it, it's up on our website, and then we went around and held press conferences to kind of highlight for our small business customers some of the things that we had learned. And one of the things that we learned, of course, was that the lack of connectivity had a huge impact on these companies. 71% of all the companies that we talked to experienced a power outage, and 75% had to close their doors for business for some period of time. Interestingly, over 50% of these customers or owners, small business owners, they lost some sales or revenue. So half lost sales, but only 11% actually experienced any structural damage. So whether you experience structural damage or not, the likelihood of losing some sales in the wake of a big storm like that is pretty high. We found that almost everybody felt that they were affected some way or another. 36% said that they were affected significantly. So what they found is that the ones who came out of this better did things like backing up critical data, had an emergency kit, protected their buildings from the elements before they left. They protected their vital business records by making sure that they were stored safely. They enabled records and data off in various locations so they weren't subject to just their one location, and a good deal of them purchased generators as well. So these are the kinds of things that you learn right after a major event and try to react to. Let's see, and I think the last slide I have has to do with communicating with regulators. And there is a growing interest, I would say, with our regulators. Insurers are regulated by each of the 50 states. So we have a robust dialogue with our regulators in each of those states on a whole variety of insurance issues. And some subset of those have to do with climate change and severe weather events. One of the things that we've seen as insurance companies over the last, say, 3 years, I think, is that a number of states and a growing number of states have required that insurers over a certain size report to them about how we look at climate change and how we are adapting and the kinds of measures that we are taking. And we just completed the most recent survey that was asked of, like I say, this number of states. And if last year is any guide, they will be presenting it, and it will be available to the public. We also communicate with our regulators through our trade association, and for us, the Hartford American Insurance Association is our major trade association. And we, for example, again, if you look at Sandy, one of the recommendations that AIA is making to the regulators is that they kind of figure out how to have a more standardized process, especially across states if they can figure it out, so that what generally happens in the wake of a storm is that the regulators want to know, well, how many claims there are and how quickly they're being paid and who is being affected and those kinds of things. And but the issue is that historically, in every single jurisdiction, they ask the question slightly differently, and they put different timelines on those questions. And at a time when companies are working hard to deal with our and help out our own customers, we want to be very responsive to the regulator. We believe that if they could decide in advance a way a methodology for the kinds of information that they would like immediately after the storm, that we could then more quickly and more effectively respond. So we have an active dialogue with the regulators on questions like that. And again, in the case of Oklahoma, I think the insurance commissioner was very hands-on. He created a center in a parking lot close to the devastation, where he set up a shop for the insurance commission, and he invited insurance companies to set up at the same shop, which we and many others did with our mobile units. We've got RVs that are set up to do this kind of work, and so we kind of, during the immediate aftermath of the storm, had direct contact with the commissioner and his staff, as well as with our customers. Well, I think that's what I wanted to get through, and I'm more than happy to take questions.
Great. Thank you very much, Jay. That was excellent. I wanted to start off by asking a question about some of the climate or weather-related data that you might look at, and to know whether there are specific indicators that the Hartford or the insurance industry at large kind of looks at. And it could be things that they look at kind of year to year, like an El Nino forecast or another type of seasonal forecast, or for the long term, thinking about sea level rise kind of over the course of decades. If there were any kind of particular indicators or particular pieces of weather or climate data that are of real interest to your company or your industry.
Well, let me try to speak a little bit for our real experts in our enterprise risk management part of the company who work on climate modeling in particular, and we do have people who peruse the science all the time. I would say that the greater interest is to understand what what climate scientists are saying about the changes, and trying to understand geographically inside the United States what those changes may mean. And as you know, these things can be, it really depends on the year in terms of, the Hartford's, our financial outcomes are in part related to how we do on catastrophes. And if you look, for example, in 2011 for the Hartford, I think that was the largest payout in claims for us on natural catastrophes. We paid out $745 million as a company, and that was more than the average in the prior 10 years. In 2012, our payout was $706 million, which is lower, but kind of on par with 2011. Now, 2013 is looking to be, speaking on October 30th, 2013, it's looking to be a much smaller cat year for us, and I think for the rest of the country, the rest of our peers. So it really can vary quite a lot year to year. And so, but in general terms, what we're really trying to get to is to understand how climate change will affect our individual insureds, at the zip code level. We can understand that for lots of different things in terms of house fires or crime, or you can understand where accidents are likely to, what the preponderance of accidents is in a certain zip code. But when you try to get that kind of level of detail for climate change, it's really, I think, beyond the capabilities right now. When it comes to sea level rise, obviously, you've suggested that will be an area that will take much longer time. I would say, the Hartford and I think all of our competitors care about. We want to keep the customers we have, and we want to be there, and we want to keep. We don't want to just give up customers for no reason. We do generally write insurance policies just for 1 year. Some are for 5 years, but generally, in terms of the actual risk that we are bearing for the policyholder, our view is generally 1 year out or less. Does that help?
Yeah, that does help. I think especially this kind of emphasis, the timescale does help, I think, in terms of what types of climate data you might be looking at, and the emphasis on kind of more resolution spatially to really get down to the zip code level. I think that's certainly a challenge for climate science, but to you're thinking at the customer level, not just kind of at these large regional scales, which is unfortunately often the level we have this climate information. You mentioned, that this year, likely driven by a quiet hurricane season, has been, less payouts than some of the large payouts in the last 2 years. Kind of the flip side to that, do you think, or have you seen in some of the recovery efforts from some of the events of the last 2 years, that people are rebuilding to reduce their long-term risk? I guess that's big part A of the question. And part B, are there ways that either the Hartford or the insurance industry kind of offers incentives or can offer incentives for people in this recovery mode to rebuild with less risk?
Right. Well, I think there's been a lot written about that very question, especially in newspapers in the Northeast, I suppose. And so, I'm speaking a little bit outside of being someone at the Hartford and rather just a general student of this subject. I would say that it does strike me that more and more you have, especially maybe at least in the Northeast, in the wake of Sandy, you get a much higher recognition, understanding on the part of the general public that such events can take place, and that and if you are not properly insured, you might find yourself with a huge loss. That's of course why people buy insurance, is because it's you're paying every month for an occurrence that you hope never happens, but if it does, then you're going to be made whole. You will not suffer. You personally suffer a catastrophic loss, and so I do think that as people look at this and understand the insurance that they have, especially from flood, which is again borne by the federal government of the National Flood Insurance Program, they can see the limits to it, and the changes that were the Congress voted to it a couple of years ago, where the subsidized portion of flood insurance, I think, the National Flood Insurance Program, they would tell you that 80% of the flood insurance that they sell is at actuarially sound rates, but that 20% is subsidized. And so the reforms that passed a couple of years ago aim to reduce those subsidies, and in particular, they would come in very slowly for someone who owns their own home, but for a second homeowner and lives in that home. But for somebody who's owning a second home, those subsidies would go away rather quickly. So they would face some pretty high prices for flood insurance going forward. That price signal, I mean, is pretty dramatic apparently in some cases, but that would certainly signal to people what the risk is that they face in continuing to live in those areas. So I think that in general terms, the degree to which insurers can price and properly price the cost of living in an area that is risky relative to another area, then that's an important thing that insurance companies can do.
Thanks, and I might argue, this is my own 2 cents, that price signal has been so effective in mobilizing people that they've actually pushed to delay the phase-in of some of those bigger waters reforms.
Yes, I noticed that.
So yeah, I think that the proof is there. This is a question that we received, and we're going to extrapolate a little bit from it, but wondering if you could comment a little bit more about partnerships that you have. You mentioned working with reinsurance folks, cat modeling community, some of the research researchers in the field, but wondering if you're any sort of partnerships with federal or state agencies that are trying to boost preparedness. I know the Weather Service has some programs. The Department of Interior's hazards folks, I think, are really getting involved after Sandy. And there are a lot of different, either state or federal initiatives to kind of boost preparedness. I'm wondering, as a private sector insurer, what role has the Hartford had in those, or could have?
Yeah, it's a good question. I would say at this point, to date, I would say the formal partnerships are very minimal, I would say. And looking forward, I could imagine that there will be. I think that there's a general understanding as I go around that people look to insurance companies to price for the risk and to have this expertise and this knowledge. And I guess I would say that insurance companies and our and the people who we work with to talk about how the insurance mechanism works are very pleased to engage in a dialogue on that. I'm thinking I should have mentioned the Hartford and lots of other insurance companies support something called the Insurance Information Institute. They have some fantastic information about all of these issues I've been talking about today, and really and are the kind of oftentimes a spokesperson for the industry generally. And I know they kind of respond to just about any request to speak about how the insurance mechanism works, and can imagine that that there might through their work that you could see some more partnership. I guess when I look at it, we do have a very robust dialogue with states, and I think we're growing one with the federal government about what we're doing and how we're operating. To date, I'm not aware of any specific public-private partnership where you could marry a private insurance company with a public entity to come up with some insurance solution. The one that comes to mind, I guess, is in terrorism risk, where we do have it. We've kind of agreed with the federal government to share the responsibility for terrorism. When it comes to the National Flood Insurance Program, I should say that the federal government looks to private companies, including the Hartford, to offer this insurance for them. We don't hold on to the risk, but we sell it through. We help the federal government sell this insurance, and then when there are claims, we use our claims handling expertise to help the federal government working with the people who bought that insurance. So I guess there's a very practical, long-standing way that private insurers work with the federal government, but I don't know that that's what the caller was thinking about.
But I think it's still an example of where there is kind of an overlap and a potential mechanism for some of the risk-based analyses that are housed within the private sector can inform some of the changes that are going on in the public sector, at least in my mind. This is me speaking. One last quick question. Just for some clarification, if there was any sort of comparison in what the claims might have been from some of the events that you mentioned as you were kind of going through some of the big tropical storms and hurricanes, the claims when the coasts, the kind of large storms, let's say Andrew or even previously, when the wealth and the population weren't on our coasts, if there is a sense, just kind of a magnitude comparison, or any references or resources that someone could go to compare some of those past events to what's some of the impacts of the events happening more recently.
Right. Well, I would certainly refer to the Insurance Information Institute. I also know that the modelers and that when we look at things, we try to understand, for example, what building codes are in place in an area, where the floodplain is, and how much building there's been taking place in a floodplain, because issues like that will help us understand what kind of losses we will face. For example, if there is a big, very damaging hailstorm event goes through an area, if our policyholders have hail-resistant roofing material, then we know that our losses are going to be lower. So there is, I think there are ways to, in public policy ways, to help build more resistant structures to these events, and to the degree to which we do that as a country, the policyholder is well served because their losses are going to be lower. The insurance company is well served because it will pay out less in claims, and I think therefore it would be less disruptive economically. So those things are all in the interest of the national policymakers as well.
Well, great. Well, I think we could probably ask and have you answer questions for much longer, but unfortunately our time is up. I want to thank everybody for joining. I apologize to folks who sent in questions who we didn't have time to get to, but I really appreciate everyone's interest. I think we had some great questions. And Jay, thanks for your candor in answering as well as your great presentation. I want to give a quick plug. We have 2 more webinars in our Business Resilience series. The next one featuring American Water will be November 13th, and the final one will be December 4th. So please register and join us again. If you have any follow-up questions, please feel free to contact me or anyone else at C2ES. My email is casolaj, C-A-S-O-L-A-J, at c2es.org. Thanks again for joining us, and thank you again, Jay, for being a great discussion leader. And hope to see everyone again in November.
My pleasure. Thank you.